Greetings, and welcome to Investor Web, the place where investment knowledge turns into wealth. We're here to guide you through the labyrinth of financial markets, demystifying the complex world of investing, one video at a time. Today we're going to delve into a topic that stirs up a lot of emotion and confusion among investors: inflation. It's a term that's bandied about a lot, but how many of us truly understand it? More importantly, how many of us know how to effectively fight it without making common and potentially costly mistakes? Well, that's exactly what we're here to discuss. We'll explore the pitfalls and missteps that investors often fall into when trying to combat inflation, from misguided gold rushes to the oversight of cash and bonds. So if you're ready to navigate the often tricky waters of inflation, stay tuned. First, we must understand what inflation is and why it matters. Inflation, in its simplest terms, is the rate at which the general level of prices for goods and services is rising and subsequently purchasing power is falling. Think of it this way: when inflation increases, every pound, dollar or yen in your pocket buys a smaller percentage of a good or service. But what causes inflation? At its core, inflation is typically caused by an increase in the supply of money relative to the output of goods and services. This can occur when governments print more money to deal with a crisis, or when demand for goods and services outstrips supply, causing prices to rise. Inflation also has a direct impact on the economy. Moderate inflation is often seen as a sign of a healthy economy, as it suggests that consumers are spending and businesses are investing. However, when inflation gets too high, it can lead to economic instability. Prices may increase faster than wages, making it harder for people to afford goods and services. For individual investors, understanding inflation is crucial. Let's say you've invested in a bond with a fixed interest rate. If inflation rises, the purchasing power of the interest payments you receive will decline. In other words, even though the amount of money you're receiving hasn't changed, what you can buy with it has. Inflation can also affect the stock market. When companies' costs go up, they might need to charge more for their products and services to maintain profit margins. This can lead to higher prices for consumers and potentially slower economic growth, which can in turn affect stock prices. So why does inflation matter? Because it affects everything from the cost of living to the price you pay for a cup of coffee to the returns on your investments. It's a key economic indicator that can signal the health of an economy, and it's something that everyone, especially investors, should keep an eye on. Now that we know what inflation is, let's delve into the common mistakes people make while trying to fight it. Gold, the classic refuge during inflationary times, but is it always the right choice? Enter the gold rush, a phenomenon that has punctuated economic history in various parts of the globe. This is when investors, driven by the fear of inflation, rush to gold as a safe haven. Let's delve into why this might not always be the best strategy. Consider this: gold is a non-yielding asset. It doesn't pay dividends or interest. Its value is primarily driven by market sentiment, not by underlying fundamentals like earnings or economic growth. So when investors flock to gold in times of economic uncertainty, they are essentially betting on fear, not on the economic productivity of the asset itself. Moreover, the price of gold can be quite volatile. Yes, it tends to rise during inflationary periods, but it also tends to drop sharply when the inflationary fear subsides. This volatility can lead to significant losses for investors who bought at the peak of the gold rush. On top of that, gold doesn't directly contribute to economic growth. Unlike investments in businesses or infrastructure, buying gold doesn't create jobs, improve productivity, or spur innovation. It's essentially a zero-sum game where one investor's gain is another's loss. So while gold might seem like a safe haven during inflationary periods, it's important to understand its limitations. It's not a magic bullet that can protect against all the risks of inflation. It's a tool. And like all tools, it works best when used appropriately and in conjunction with other tools. In fact, a well-diversified investment portfolio consisting of a mix of assets like stocks, bonds, real estate, and yes, a bit of gold, can often provide a more robust defense against inflation. This approach allows investors to benefit from the strengths of each asset class while also mitigating the risks. As we see, gold, while a safe haven, isn't always the best inflation fighter. Cash and bonds often overlooked, yet they play a crucial role in an inflationary environment. Let's delve into a case study that illustrates the implications of neglecting these two assets during inflation. Imagine a boat on a stormy sea, bobbing and weaving with the waves. That boat, my friends, is your investment portfolio, and the stormy sea is the inflationary environment. Now, what if I told you that cash and bonds are like the anchors that can steady your boat in the midst of this storm? In the mid-90s, a group of investors decided to ignore these anchors. They were lured by the siren song of skyrocketing stocks and real estate. Cash with its low returns seemed unappealing. Bonds with their fixed interest payments seemed inadequate against the rising tide of inflation. Fast forward to the turn of the millennium, and the storm hit. The dot-com bubble burst and real estate prices plunged. Those who had ignored cash and bonds found their boats capsizing in the turbulent market. Why? Because cash offers liquidity. In a downturn, it can be used to quickly seize opportunities without the need to sell off other investments at a loss. Bonds, on the other hand, provide a steady stream of income, regardless of market conditions. They act as a buffer, absorbing some of the shocks from market volatility. In contrast, those who had kept a portion of their portfolio in cash and bonds weathered the storm. Their boats stayed afloat, anchored by the stability these assets provided. They were able to buy undervalued assets at bargain prices, using the cash they had held onto. The bonds in their portfolios continued to pay out, providing a reliable income stream even as other investments fluctuated wildly. So you see, ignoring cash and bonds can be a costly mistake, especially during inflation. They may not be the most glamorous assets, but they provide stability and flexibility, two attributes that are invaluable in a volatile market. Cash and bonds, when used correctly, can serve as a powerful tool during inflation. At inflation, a complex economic phenomenon needs a well-thought-out strategy, not impulsive decisions. Today, we've journeyed through the economic landscape, delving into the intricacies of inflation and the potential pitfalls of hasty investment strategies. We've seen how the allure of gold, while enticing, can lead to a gold rush mentality that often ends in disaster. And we've also explored the risks of turning a blind eye to traditional investment vehicles like cash and bonds. In the face of inflation, it can be tempting to latch on to quick fixes or to let fear guide our decisions. But as we've discovered, these approaches rarely yield the desired results. Instead, they can exacerbate the very problems we're trying to solve, leaving us worse off than before. The key to successfully navigating inflation, as we've discussed, lies in adopting a balanced and informed approach to investment. This means not putting all our eggs in one basket like gold or real estate, but diversifying our portfolio to include a mix of assets. It means staying informed about economic trends and understanding how they might impact our investments. And it means being patient and strategic rather than reactive in our decision-making. Inflation is not an enemy to be fought, but a phenomenon to be understood and navigated. By doing so, we can turn the tide of inflation to our advantage, using it as an opportunity to grow our wealth and secure our financial future. Let's not forget, the world of investment is a vast and complex one. But with the right knowledge and approach, we can not only survive inflation, but thrive in spite of it. Remember, the key to fighting inflation is not in rushing to gold or ignoring cash and bonds, but in understanding and adapting to the economic landscape. Thank you for joining us at InvestorWeb, and don't forget to subscribe for more investment wisdom.